Howdy, my name is Shane Ellis. I'll be going over my Chapter 1 to 4 project over the Northland physical therapy problem we got from McGraw-Hill. Hopefully, I can get all the way through the full accounting cycle in this issue without looking too silly, but I think I can teach it pretty good. Alright, so start off with journal entries. So all of these transactions, let me get my laser pointer. Right here, during 2024, need journal entry. So to start it off, we'll go with A. Borrowed $15 cash on July 1st, signing a 6-month note payable. That's a short term. So go over here, we'll debit 15 to cash and credit 15 to notes payable. So the debit there and the cash is acting as receiving cash in hand, and the credit to notes payable is acknowledging that that note payable has to be paid off in the short term specifically. We're going to be here. So this transaction, we purchased equipment for $18 cash on July 2nd. So that means we need to debit equipment for 18 and credit cash for 18. Equipment, essentially, we're getting 18 worth of equipment and spending 18 worth of cash. C issued additional shares of common stock for $4 on July 3rd. So increase in cash, you debit cash for, and you have to acknowledge the common stock increase. So you credit common stock for. Software, purchase software on July 4th for $4 cash. Right here, D. So you have to acknowledge you got $4 worth of software, or $4 worth of software. It's 1,000, so $4,000 for software. So 4 to software, 4 to cash. You're paying cash for it. You're crediting. You're paying cash, and you're getting for software. All right, let's go. E supplies received on July 5th on account for future use, $6. So you receive 6 of supplies. You're going to have to pay 6 in the future. You acknowledge that by crediting accounts payable and debiting supplies 6. CF recorded revenues on December 6th of $50, including $10 on credit and $40 received in cash. So you're going to have 2 debits here. Not super typical, but at least what I've been doing. You debit cash 40 because you receive 40 in cash, and you get $10 in accounts receivable. They're going to pay you later. You still put 50 in service revenue credit. You're making 50 in revenue on that. It's a $50 job. 40 plus 10, 50. Credit and debits balance. That's how we like it. Let's see. G, recognized salaries and wages expense on December 7th of $23 paid in cash. So, obviously, debit salaries and wages expense, that $23, and you credit the cash to 23 or 23,000. Collected accounts receivable, this H, on December 8th, $7. So go over here to H. You're going to have to debit cash, that's 7, and credit accounts receivable, that's 7. Paid accounts payable on December 9th, $8. So you're debiting that accounts payable, you're paying it off, and you're crediting cash. You're giving the cash away. Received $4 cash deposit on December 10th for a hospital for a contract starting January 5th, 2025. So you're going to have to debit cash that $4,000 cash deposit, and it's going to be deferred revenue, so it's going to come later. You're going to have to credit that deferred revenue. Next, we're going to move on to T accounts. So T accounts are real simple. It's a lot. It looks like a lot. There'll be 3 slides, but it's really simple. I can explain it in a few words. You just take each journal entry you make, post the debits and credits into the appropriate T accounts. So it's just a big compilation of journal entries is the way I like to look at it. After you get it all posted, you compute the ending balances, netting debits and credits, and those balances will form the unadjusted trial balance. This is just the beginning part, because then you go back and you adjust your T accounts. This is the adjusted picture from the homework. This is what I had. So you can see here, cash, accounts receivable, supplies, equipment. Let's go to one that was easy to remember from our thing. I can't backtrack in this video. Software. We got 4 of software. The beginning balance here, you enter from the previous. So that's a good thing to explain. That's one of the things I need to explain. You get your beginning balance from the previous statement. So I had $4 of software already, as we saw on the first page, and then I purchased $4 more of software. That was from our journal entry D here, and that means our ending balance is 8. So we have a total of $8,000 of software. It's the best way for me to look at it. Those are some of the temporary accounts, the expenses. Get to it later. Unadjusted trial balance. So the unadjusted trial balance, I have the journal entries here because you can use that, and it's just using the balances from our T accounts, which you get from your journal entries. It's not adjusted. The purpose of this, they just check total debits equals total credits. So you see here, you get all this lined up. This is blocking it, but it's 98 equals 98, 98. You see here, you get assets, then your liabilities, then your equity, your dividends, if any, revenues, and then your expenses. It's always structured like this on the trial balances. Adjusting entries, so stuff we have to adjust here. You got K, amortization for 2024, $1. You got a debit, amortization expense, 1,000, and credit 1 to accumulated amortization. Supplies $4 counted on December 31st, 2024. Okay, then that L right here, you got a debit 6 to the supplies expense, credit 6 to supplies. This one's a little more complicated, so you take your total supplies you had at first, adjusting supplies. You'll take that total supplies you had at first, then you have to factor in what you used by looking at what you had at the end. That's why we have $4 or $4,000 of supplies counted on December 31st when we're trying to get this. That's our ending supplies. Take what you had at the beginning, what you purchased, what you have in the end, and that's how you get to this 6 adjustment. Depreciation of 2024, $2 to the depreciation expense, a debit, and then credit 2 to accumulated depreciation. Those are always simple. In interest of $1 notes payable is yet to be recorded. So if it's yet to be recorded, obviously you have to record the debit to the expense and then credit to the interest payable. That way we end up paying it. Salaries, wages incurred, not yet paid or recorded, $5 or $5,000. Sorry, I keep doing that. So you're gonna have to debit 5 to salaries and wages expense and credit 5 to salaries and wages payable. I just think of it is when you credit that payable, it's not that you're paying it. When you credit that, you're crediting that you're going to end up paying this. You're not paying it out in these adjustments. Or else we'd be using cash or accounts payable. Income tax expense 2024 is 25, and we paid in 2025, even though it's 2025 and this is in 2024. You have to record it when it's incurred. Income tax expense, you get a debit at 5, and then income tax payable, credit 5. Adjusted trial balance. So now we go and we update those T accounts that were already adjusted when I pulled them up. That's all I had. Didn't know that's what I was doing. Couldn't access the assignment. Sorry. It would have been a lot easier to explain that way if I could just do it. But now you update your T accounts for the adjusting entries we did, but those were already there, and compute new ending balances. And those ending balances go in the same way that we did the not adjusted trial balance, unadjusted. And from those updated balances, we get this, and now we're ready to make our financial statements. The income statement, one of the most straightforward ones. You got revenue, expenses, net income. So total revenue minus total expenses equals net income, net loss. As you see here, 50 minus 43 equals 7. 7 net income, and that will flow right into retained earnings. Statement of retained earnings. You get your previous balance of retained earnings, which was 7. You'll add net income or net loss. You'll less net loss, but this is net income. And then less dividends if there are any. So that gets your total current retained earnings. So for the year ended in December 31st, 2024, we have retained earnings of 14,000. 7,000 plus 7,000 minus 0. 14,000. Real simple. Balance sheet. Balance sheet presents assets and the current assets, then total assets, current liabilities, total current liabilities, total liabilities, stockholders' equities, total liabilities, stockholders' equity. As you can see here, it's split into 2. On the left side, you see assets. You total that, and then you go over here and you get your liabilities and your stockholders' equity. Total all this, and they should equal each other. Here you see they do. 64, 64. Balance sheet is balancing. Closing entries. So, as you see here, you have to close. Let's see. We have to close the temporary accounts related to the service revenue. That includes retained earnings, depreciation, all the expenses. So depreciation expense, amortization expense, salaries and wages expense, sales supplies expense, anything related to the operations to obtain the service revenue. All these expenses go into that. You close those out. That's your closing entry. Post-closing trial balance. So this is the final step. This contains only the permanent accounts, fully adjusted, and basically this right here, this post-closing trial balance, completes the entire accounting cycle. So that was my chapter 1 through 4 presentation. Thank you very much.